Good day. Welcome to another fantastic edition of the Tax Answers Advisor with Marcelino Dodge, enrolled agent. I am, of course, Marcelino on show 63. We're going to start here in just a little bit on our main topic for the day, which is start now on your 2022 tax return before it's too late, and why this is so important. I really encourage you, if you have questions about any of my tax planning, tax resolution, or other year-round services that are offered by myself and Cash Tracks Financial, visit me at cashtracksfinancial.com, email success@cashtracksfinancial.com, or give me a call at 844-394-4287. Be happy to answer your questions and have a video conference or telephone call, whatever you would like, so we can definitely help you to pay as little tax as possible. Now we're going to jump right into the topic of today, which is start now on your 2022 tax return before it's too late. Now, why would I sit here and bring this out? We're at the beginning of December when this is recording. And so are you ready for 2022 tax changes? Well, just consider some of the areas of note that have occurred during 2022. Some IRS notes here. For example, many have heard about the 30 million unprocessed 2020 informational returns that were destroyed by the IRS, found by the Inspector General. And generally, this means that's 1099s and perhaps W-2s, a lot of information that was just gone. So hopefully, as I always encourage my clients when I work with them, you have copies, because the IRS doesn't have a copy. So be ready. You may need to have those, provide those to the IRS, regardless of what they say. I always encourage, be ready, have your copies so that you can always address any potential issues with the IRS. Also, keep in mind that just recently, some of the additions that's been happening with the IRS, the Small Business / Self-Employment Division is hiring 470 new revenue agents specializing in auditing both small individual and business taxpayers. So there could be some ramping up of audits, and especially that can happen because with those who file a Schedule C as a sole proprietor, those tend to have a higher audit rate than S Corp, C Corps, and most of your entities. So just be aware of that and make sure you're keeping, once again, good books and records, as I have talked about a number of times on this podcast over the last couple of years. So just be ready. We don't know exactly how it's going to happen, but just always keep good records and make good notations. And always, as I've talked to you constantly, use a tax professional when preparing your tax return. Now, also keep in mind, those are some IRS notes, but it's just the end of 2022 coming up here. So it may not exactly be on your mind because you have other thoughts, perhaps other more important issues, but you do start to need to think about taxes and your tax filing. Are your documents organized? Are you getting them organized? Are you organized for the year? Of course, some of your documents you probably haven't received yet, but especially if you're self-employed or in business, boy, you need to be getting organized now. Now, if you visit cashtracksfinancial.com in our client resources section, there's a very handy checklist to help you get organized. It's a free download. You don't have to put in a name or get an email address or whatever, but you can just download any of the documents from that file at that time. However, if you do want to sign up for our free, and it's a free client newsletter that we have, comes out each and every month. We don't spam you or anything. We just send it to you. If you sign up for that, you'll get our free newsletter each month, as well as you can also sign up for the weekly tax tip. Once again, sent out to you for free. And you can get this at cashtracksfinancial.com. Just sign up for the newsletter. Also, whether you're talking to us or talking to your professional, get an in-person to just meet, just kind of see where things are for you. With us, I do both telephone and video conferences with individuals or business owners to help them to be able to get better organized. Now, it's also definitely recommended that you have some type of record keeping system, whether you're old school, being it on paper and having it neatly organized, at least by month, preferably by category, is how I would recommend it. Once again, in our client resources, you can get familiar with what some of those categories would be to help you get organized. You can also do it electronically. So make sure you do that. Now, you want to do this on an individual basis. Maybe you've changed jobs during the year. Well, verify that your employers, former employers, banks, or other perhaps payers, make sure they all have a correct mailing address. And actually, the time to do that is absolutely right now, before the end of the year. That way, as they prepare any informational returns for you, your W-2s, 1099s, whatever you could possibly be expecting, or if you took a distribution from some type of retirement plan, getting the 1099-R, making sure you get that in a timely manner. So make sure all of that is up to date, because if you want to get filing as soon as the electronic filing works out, all of those addresses need to be current so that you don't have any delays in receiving your documentation. Another area to consider also is, are you having any life changes? Well, what do we mean by life changes? Of course, did you get married during the year, or perhaps divorced? Was there a new child? Did you take on a second job? Each of these areas affects your taxes. Now, do not think, well, I got married in the second half of the year, or I'm getting married in December. I'm still single for most of the year. Wrong. What the actual law is in regards to marriage and divorce is, what is your status at the end of the year? So if you got married on December 31st, you're considered married for the whole year. So you got to be thinking about planning your taxes accordingly. Now, you still can do married filing separately for the year, and that may be the best option for you. I don't know, but you need to talk to your tax professional about that. If you had a new child during the year, got to make sure you're planning appropriately there as well. If you took on a second job, did you do your W-4 in a manner that makes sure there's proper withholding? So all of these are items to stop and take a look at right now, so that when tax time does come around, you don't have any surprises. So definitely, I recommend getting with your tax professional, or if you need one and you're looking for one, we're certainly available to have a meeting to go over that information. You can upload the documents to our portal so that we can be sure to help you to make any adjustments or be ready for what the possibilities are for the taxes or potential refunds, because there's a lot of changes I'm going to talk about in a little bit in regards to how things are so different for 2021 as compared to what you're going to have or possibly receive in 2022. Also, this time, a withholding review, as I mentioned, is very important. If you're in small business and you have your own business, need to possibly take a look at, because I'm getting ready to have some appointments with individuals to take a look at how perhaps this last quarter of the year has gone. Is an estimated tax payment necessary, both federal and state taxes, because those are due on January 15th. So it's good to take a look at that now before the end of the year. That way, if you can make those payments or need to make those payments, you can definitely plan to do so. While at the same time, I'm encouraging ones, and even the IRS has put out some notices about this, about various tax scams. Yes, there's scams. They just keep coming up with new ideas. The gift card one is going around once again. So don't ever take a call from the IRS and they're saying, well, send us a gift card. Like maybe a Visa, one of those Visa gift cards. You go down to your local store, pay $2.95 for whatever, and then you put on whatever, 20, 30, 400 bucks, whatever the amount is. Don't do that. The IRS does not accept gift cards, so be watching out for those kind of scams. Anybody wanting you to pay via gift card, just don't do it. Also, another area to look at is sometimes there's some confusion about what is a tax home or what is your tax home. There's been court cases with the tax court regarding this where ones have lost because of not accurately calculating their tax home. So what is a tax home? In general, your tax home is the regular place of business or duty post, basically where you work, which includes the entire city or general area where your business is located or where you drive to do business is your tax home. Now, this can really uh, make some people a little crazy because they can live, like, for example, in Colorado Springs, Colorado, but work up in the Denver area. Well, they may be physically living or their residence may be in Colorado Springs, but their tax home would actually be like Denver because that's where their regular place of business or their regular work occurs. Now, for some individuals, especially self-employed individuals, their main place of business could actually be their home. Well, why would that be the case? Well, when you have a qualified home office, and I've talked about home offices on a previous podcast, well, if you have a spot in your home, which many people, perhaps in construction, sales, even some tax professionals, have an office that is exclusively used for business purposes. And when you have a place that is exclusively used for business purposes and have an office in the home, very well, your regular place of business could very well be your home. And to make sure you qualify for this, to have your family residence as your tax home, there are some factors you need to consider. And indeed, you need to consult once again with a tax professional about that to get the most accurate information so that indeed you are able to have that your home as your tax home and see if you actually do qualify. A question that comes up quite a bit during tax season and even off tax season I get is, well, how long should I keep copies of my tax returns and my record? Well, in general, I recommend at least a minimum of 4 years. And that is because, well, you got a 3-year statute with the IRS for most returns. But most states are about a year behind that. So that's why I always say, let's keep a year there. So that gives you 4 years. That's at least the minimum. Now, there are some exceptions where it's actually a good idea to keep tax records for multiple years and even for, we'll say, 10 or 20 years. And what would those reasons be? One is that if you had a large net operating loss that you're carrying forward to additional years, well, you would want to have records of that net operating loss until it is completely used up. And then even 3 years beyond that, that way, you're beyond the IRS review period. So net operating loss is one reason why you would want to definitely keep tax records for much longer than 3 years. Some people say at least 7, but usually about 3 to 4 is pretty good. Like I say, unless you have a net operating loss. Or another possibility as to why you would want to keep your tax records for a longer period of time would be if you have a long-term capital loss. Say if you lost tens of thousands of dollars in the market, but you don't have a capital gain or a long-term capital gain to offset that. Well, according to current rules, you're limited to $3,000 per year that you can carry forward. And your capital loss would carry forward until that capital loss is gone, or unless you have some type of offset for a long-term capital gain. And so as long as you're carrying forward that capital loss, you want to make sure that you keep the records of, I would recommend keeping it all the way back to the beginning in every tax return up until that capital loss is used up. And even then, 3 years beyond that to get beyond the IRS statute. So that's the other reason why you would want to definitely keep records for a much longer period of time, is if you have a long-term capital loss that you are constantly carrying forward. Sadly, another area we see is that there are still some people waiting for their returns for either 2021 and 2022. Latest figures I received is that as of November 11th, 3.7 million returns were still unprocessed by the IRS. These are individual tax returns. These include 2 million returns that were paper filed and 900,000 unprocessed amended returns. And some of these can still take another 20 weeks. So we're talking another 5 months there probably. So unfortunately, if you had to file an amended return for 2021, you could still be waiting for it. In fact, I know of some of my clients that we filed like back in May of 2022 an amended return, and they're still waiting for that check. So while ones can use, you can just keep checking information. I would recommend at this point not doing, they updated it daily, but just due to how far they're behind, I would recommend not doing it more than once a week, because you can really just drive yourself crazy if you're going to, where's my refund on irs.gov, or where's my amended return? You can use both to check them, but with the way the IRS is running, I recommend right now no more than once a week, because if there's any changes, you'll definitely see them within a week. It'd be even though it does update daily, but once a week would certainly suffice and certainly allow you to be able to keep up with it there. And then once you see an actual change on it, then maybe you can start doing it every day. So what have we learned over the past couple years when it comes to filing our tax returns? One is definitely, if at all possible, you want to make sure you are filing your tax returns electronically. That gets you the fastest processing times and also alleviates from some of this processes where you have unprocessed paper filed tax returns. Now, sadly, there are situations where ones do have to file on paper, maybe because over dependent situations, maybe someone filed for a dependent or a child on a tax return that they weren't supposed to file for or claim, which is really sad when they do, which forces in divorced parent situations, one perhaps to have to file on paper to get it fixed. Now, there are situations where in ways that you can actually help prevent that. Of course, file as soon as you possibly can, like the day electronic filing opens. If you have all your paperwork, your W-2s by that time, which we, as of this recording, we don't have that date yet, and we probably won't actually learn it until either later in December or possibly early in January, but it could be a little earlier this year because there's not a lot of significant last minute changes yet, I guess I should say, by Congress in anything with the IRS. So we can see whatever happens between now and the end of the year. There still could be, but right now there's not really any big anticipated changes. Now, another reminder I like to put out here is that if you have health insurance through the marketplace, whatever the exchange is in your state, make sure that you have all the information updated with them as far as your income, so that they calculate your premium tax credit correctly. And then keep an eye out on your account. You can probably download it, I'm guessing, from most of the exchanges, your 1095-A. Make sure you have that before filing. It's going to be absolutely essential for you to be able to get the proper amount of premium tax credit, which, depending on your income, you may actually get a little bit more. So just make sure you have that form. Once again, that's the 1095-A for insurance on the marketplace, so that, again, you get everything that you do deserve or can qualify for through the exchange. Now, some key updates we're going to remind you of today in regards to keeping in mind for 2022, because there's several things that are changed and several areas that are not good for taxpayers if you're the taxpayer. Now, one area I'm going to mention here, very positive right off the bat, is that if you're on Social Security, you're actually getting a good raise, 7% is the cost of living increase going into 2023, which is the highest in decades. So keep that in mind. That's a good thing, but yet is that really going to help with other situations? I don't know. I don't know your situation, but everybody just that's a good news. Now some unhappy news. Did How many people realize they thought the American Rescue Plan was really, really fantastic when it was passed in 2021? Well, there was a little provision in that made a major change for taxpayers across the spectrum. And what that is that you sell items on eBay or Etsy or Mercari or one of those areas online. Do you sell stuff? Do you have third-party payment processors that you're using? Payment apps such as Venmo, Cash App, Zelle, PayPal, any of those? Well, there's a provision in the American Rescue Plan that majorly changed how reporting is done. And what that is that if you sell one item that's over $600 or several items that add up to more than $600, guess what? You're going to get a 1099K from your processor. And for many, that's going to be a first time occurrence. Now, you could just be selling personal items. You may not necessarily be in business, but that 1099K form, which you could be receiving, indicates that you are in business. Maybe you just have a hobby. Maybe you're just getting rid of some personal items. Who knows? But be aware, if you get that 1099K, you better bring it with your tax information. And that's one of the areas that in this office, as I talk to people, whether they're online or as they come in physically, it's going to say, have you sold any items, products, or services online? And of course, if they say yes, then the next question is, have you sold more than $600? And many people are going to just really be caught off guard by this, because what's going to happen is the same thing that happens every year, is that many are going to file, get their W-2s or 1099-Rs or whatever they're having, their 1095s for their health insurance, come in and they're going to file. And then 2 weeks later, guess what? A 1099K shows up and they're going to be like, well, what do I do with this? Well, guess what? Then we have to file an amended return to make sure that gets addressed. And we also have to address whether you're actually in business or if you're just a hobby or if it's just personal items, whatever it is, it has to be addressed, because what's going to happen is that the IRS goes and matches later on. And when that happens, you could end up getting an underreporting penalty for income from the IRS. So that's something just to be on the lookout for. So yes, if you have sold on through Venmo, Cash App, Zelle, PayPal, any of those services, you're going to get a 1099 from them for this year. So just be aware of it and be watchful. And perhaps if you have, you may have to wait till you get that 1099K. So just be aware of it. If you're an educator, qualified educator, well, you get the above the line deduction that actually goes from $250 to $300 for 2022. That is another little bit good news. It helps with the taxes a little bit, but it's good for our educators. Now, think about this. Many people last year, because of the American Rescue Plan, got larger than expected refunds. But this year, for 2022, there has not been any stimulus payments at all. There is not a recovery rebate credit. And there's going to be a few other items I'm going to mention here in just a little bit. So just be thinking, you're not going to get, basically, there's not going to be a bigger refund. So if you get a smaller refund than you got in 2021 for the 2021 tax return, be aware, this is why. All of these items for 2021 expired. Now think about these other areas here. The child tax credit is only $2,000 for children 16 and under. That's huge. That's all that is. And only 1,500 of that is refundable. So yes, a big change. So if you have however many kids you have, it's only 2,000, not 3,000 like it was in 2021. And only 1,500 is refundable. So just keep that little point in mind as you move forward, because also those advanced child tax credit payments that was in 2021 received from July through December, those 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 obviously didn't happen in 2022 either. So be aware the refund is going to be smaller in many cases for one. Another area, the child and dependent care credit is dropping significantly. It's only 3,000 for one, a maximum of 3,000 for one, or 6,000 for more than one. Now, a huge difference from 2021 to 2022 is that this credit is non-refundable. Basically, it reverts back to what it was in 2020. So keep that in mind as well, is that if you can definitely take this credit on your tax return, but you have to have tax to be able to get anything back for it. So this could also affect your tax refund so that it would be less than what you had anticipated or what you may be thinking it could possibly be. So these are adjustments. Talk to your tax professional about them, and we're always available to discuss this as well. Another area that's still with us is the state and local tax limit of $10,000 on what ones can deduct for state and local taxes on their itemized deductions on the tax return. This is significant. There's a lot of high tax states that challenged the constitutionality of this, but the Supreme Court said, nope, we're not going to hear this case. So that is still with us. Charities. Are you making donations to charities? Do you have a charitable deduction that you're taking? Well, of course, we think about in 2020 and 2021, there was actually an above the line deduction of $300 for an individual in 2021 and $600 for married couples. This year, guess what? You don't get a deduction for charitable deductions unless you qualify to itemize. Now, some area that happens with that, though, you think about is the fact that some states, and I know Colorado is one of them, will actually still give you a deduction for charitable donations. If you have donated like above $500, they give you whatever is above that $500 threshold if you did not itemize on your tax return. So make sure the state level is checked because you can still get that charitable donation at your state level possibly. And that does vary again from state to state. If you are making donations to charity, one thing I always tell people is do not give cash. Because if you give cash, you have to have some type of receipt for that donation. And you have to ask the charity to give it. So when you're putting cash into whatever, like into a donation pile or a donation can, whatever it is, be aware that is free money. That's free. You don't get any deduction for that. Now, I always instruct ones, make sure you write a check or use a credit card to make such a donation, because that creates a record. Essentially, that creates a receipt. Now, if you do have a donation of over $250 in one day, you do need to have some type of acknowledgement letter from the charity. And I recommend getting that right away if you want to plan on deducting it, or you're going to be able to deduct on your tax return. Now, that is an area where ones have had huge problems, big problems. Once again, at tax court, they ended up at tax court. They took these huge charitable deductions, but they did not have this acknowledgement letter from the charity that also states no goods and services were received for this donation. So yes, make sure you have that. Now, I always recommend, or highly recommend, I should say, if you're going to give something to a charity or for a nonprofit, just give cash. It is the easiest to support, the easiest to do. You get the letter of acknowledgement, the easiest to establish the value. Now, some individuals like to give some type of non-cash gift, property, collectibles, could be just about anything you name. Now, the problem with these is that the value. What is the value of these? What is the deductible values of these? Yeah, the charity can give you, well, we're going to give you $5,000, whatever credit or amount of donation for this. but is that going to hold up in an audit? Well, if you're going to give something of significant value to a charity, it is highly recommended that you have some type of appraisal completed for that property so that you can have that written documentation once again to support this is the value of the donation that I made. Here's the market value of this donation so that you can maintain the deduction upon audit with the tax return. So keep that in mind if you're thinking about audit donating something before the end of the year. Make just do cash. But if you do something that's non-cash, of course, there's an additional form that goes with the tax return if you're itemizing. And then, of course, have that appraisal and put that with your tax documents so that you are able to take that full deduction upon audit. Are you a shareholder of an S corporation? Well, you're supposed to be keeping track of your basis. And in most cases, your tax professional that you're using is helping to track that basis because it's not tracked at the entity level. The S corp doesn't keep track of your basis. Many people think that the S corp does. No, the S corp really is not required to track your basis in that corporation. You need to do it, and it would be wise to ask about your tax professional. Are they helping you to do that? Well, the IRS is kind of forcing the issue here. There's a form when you have an S corp and you're filing your K-1 on your Schedule E on your tax return, there's a new form. It's a 7203 that must be filed with the tax return when you're claiming a loss, a loan repayment, a stock sale, or a distribution. And basically, that's a form showing that you have basis to be able to do all those that I just listed there. And you need to make sure that if you do have that, that your tax professional is doing that, and even ask. I mean, because when I pull those out, review those with a tax client that I have, I say, okay, look here, here's your tax return. We review it. Also, here's your form 7203 that's applicable with your tax return. That's especially if there's a loss or a distribution that they take. If you've been in business, we really love the Tax Cuts and Jobs Act because many people talk about other areas of that particular bill. But one of the great areas of that bill was for business. It was such a business-friendly bill. It just doesn't get the proper recognition, is that more businesses can use the cash basis of accounting, which just makes it so much easier for small business. And that is if the annual revenues, in this case, we're looking at 2019 through 2021, if those annual revenues of the business are under 26 million, business can use the cash basis of accounting, which covers vast majority of businesses throughout the country. And I know a lot of different professionals do a lot of different things, but I'm a big fan of using the cash basis of accounting. It just makes everything so simple for my business clients and actually for me as a tax professional and taking care of them from a tax basis. It just makes it easier. So if ones can do that, definitely do that. Now, if you do have a business that has inventory, you still need to do some accrual with that inventory by law, but that's a little bit separate, but still needs to be done. But overall, if you're just doing services or a non-inventory type of business, just stick with the cash basis. You don't need to get too fancy using accrual. I know some tax professionals and even some accountants prefer people using accrual, but I, as a tax professional, really encourage ones to use cash basis. It just makes it simpler overall. If you're a business owner and you have employees, well, I just want to keep in mind, and I want to remind you that worker classification is a huge issue with the IRS. You have to be able to classify your workers correctly. So make sure you do. Are they employees or are they independent contractors? I did a whole podcast on this, again, reminding employers that don't try to get out of the employment taxes by trying to pay your employees as independent contractors, because it can really come back and harm you. And one of the areas I've really seen in this is at the degree of work controlled. How much do you, as the employer, control the work? If you provide complete directions on how they do the work, if you gave complete direction, you set the hours, You set when they start, when they stop, when they go home, all of that. They could be classified as an employee. Has the individual, how much have they invested into the business? Are they going to your place of business all the time? Are they using your equipment? All of these, they could be classified as an employee. Also, can you fire them at will? This is just a small little tidbit of it. And a warning I always put out to employers here is that it's more likely that a state Department of Labor will catch you than the IRS will. But if the State Department of Labor does catch you, it gives you a nice, when they reclassify, you do have to go back and report it with the IRS. And that can actually be a benefit because if you voluntarily, it becomes a voluntary situation with the IRS, the penalties and the stuff can actually be reduced and can actually make it a little bit easier for you to deal with that. So make sure that all employees are then classified correctly. Gift tax exclusion is $16,000 for the year. So certainly if you have some gifts you want to give, 16,000. Now that's important because you don't have to file a gift tax return when you gift that amount out to each individual. Like you have a married couple gifting to another, like their kids. Well, each of them can give 16 without having to file a tax return. So essentially they can give like 32,000, but it has to come from each of them separately and has to be a separately written check as well. That's what I always recommend in doing that. Now, we consider that we have 100% meal deduction. Yes, this is the last year for 100% meal deduction for 2022, and then it drops back down going into 2023. So if you've been tracking those, certain meals qualify for this 100% deduction. So hopefully you've been tracking that correctly through the year. Now, if you're in business, you're using your vehicle in business, especially if you're a sole proprietor, I always remind ones, keep a mileage log. And there's an excellent app that ones can use called Mile IQ to track their business mileage, because there's so many times that ones just miss it because of or miss deductions because they're not tracking their mileage properly. But now definitely includes you do that. And this year it is vitally important because we have one of those mixed up years. Yes, hopefully, and I got to remind all of my people of this, and I'm going to keep doing so, is that there's two different numbers depending when you drove your vehicle during the year. So from January 1 to June 30th, 58.5 cents a mile. January 1st to June 30th. So miles have to be divided up between the first half of the year. And then you got to have a number for the second half, July 1st to December 31st. A different number for mileage, 62.5 cents a mile. Now, one of the things we talk about in these tax meetings that I go to is, where does this half a cent come from when they make these out? The answer we always have is, we don't know, but it's there. So we deal with it and we just move on. So yes, make sure you have a good mileage log, and always, as you're looking at for business purposes, for this year in particular, you got to have two numbers once again for the first half of the year, January through June, and then the second half of the year, July through December. Make sure you got those separated and have it good and accurate there. Now, if you're using one of those mileage apps, that's going to probably make it real easy for you to do so. And yes, while you're keeping a mileage log, it's important also to note that you need third-party verification. So what I would suggest is, if you're one of those individuals who likes changing your own oil, just for record keeping and tax purposes, I'd recommend having someone else do it a couple times during the year for you. That way, whether you get some type of auto repair or you get a mileage or an oil change, they always record the mileage, and that becomes a part of your tax records to verify through a third party your mileage. It's something that the IRS will look for. And certainly, as we once again mentioned about the IRS is hiring more revenue agents, something to keep in mind as you look for those. Foreign bank accounts. Are you a signatory on a foreign bank account? Do you have a foreign bank account. If these apply to you, you probably need to file what's known as an FBAR due by April 15th of each year. This is a foreign bank account reporting. And there's a couple questions on the Schedule B on the tax return as well that could apply. So if you have anything with foreign bank accounts, I mean, we discussed that in our engagement letter here about foreign bank accounts, that our clients are disclosing those to us so that the proper forms can be filed. And if they don't disclose them, well, once again, the penalties for failure to disclose those foreign bank accounts, those can be pretty severe. So keep in mind that if you do have a foreign bank account, make sure you disclose it on the tax return. It's just a disclosure. It's not really doing much else, but you do need to disclose it. If you're an heir of an IRA, or you have received an IRA as a beneficiary, some quick points to keep in mind there. Distributions, how are they taken? Well, that depends on the age of the decedent, the person that died. And it depends if they're getting a required minimum distribution. So there's just some quick clarifications I'm going to give on this, because there's been some confusion out there, some misinformation. So if the person that left you the IRA, if they are over 72 and you're an eligible designated beneficiary, you must take the RMD every year if they were already taking the required minimum distributions. But then you got to make sure you take out the balance by the end of the 10th year. So that's if they're over 72 and already taking distributions. If they're under 72, you as the eligible designated beneficiary can wait until the end of the 10th year actually to take out the entire balance. So you don't have to take the payments over the 10-year period, but you can wait till later on. As to which of these in this situation is better to do, wait or take it all, depends on the circumstances of the individual, of the eligible beneficiary. Because once again, you got to think about how much is that going to affect my tax over the 10-year period, or how's it going to affect my tax in year 10? Yeah, we don't know. But it's something thinner and something that you need to talk to a tax professional about, just so you can make the best decision as to whether you should take the taxes or take out the distributions through the 10-year period. Now, I mentioned a few times the term eligible beneficiary, eligible designated beneficiary. Now, there's some that this eligible designated beneficiary does not include. Okay, notice this beneficiary does not include the surviving spouse, a disabled or chronically ill beneficiary, and does not include someone that is no more than 10 years younger. So basically, if you have a 75-year-old and their beneficiary is someone who is 66, then that individual is not an eligible designated beneficiary. So just keep that in mind there. Other items to keep in mind as we go through this year, finish up this year. You can still actually start and contribute to retirement plans before the end of the year. Now, especially if you're a small business person, you can contribute to a 401k, a SEP IRA, or a traditional IRA before December 31st. You can open up and do that before December 31st. It's a really a great area to do if you are self-employed and looking for at least some way to help save on some taxes. Now, it's not going to be it's not going to help you on self-employment tax for you personally, but it will help you on regular income tax. But it is something to consider and to think about and look at. Now, also, a benefit of contributing to these is that you may qualify for the saver's credit. It may bring down your adjusted gross income so you can qualify for the saver's credit. So, but you can do that you can contribute more than $2,000 to these, but you get the saver's credit for up to $2,000 of these. So keep that once again in mind. Now, I'm going to put out some warnings here real quick for you in regards to this. 2 warnings I put out for individuals that's been out here. One is that I do not recommend you to have gold or silver in your IRA. Now, let me step back a little bit though. Make sure that this gold or silver is not in your possession. If it is invested in this, there are some schemes out there. This has gone through tax court and has been proved you don't do this. Is that there are some websites that can promote that you can have a self-directed IRA and you can take possession of it through an LLC that you own. No, don't do that. And why not? Sounds like a good idea. Well, a person tried this self-directed IRA, had their LLC set up, and took physical possession of the gold for their IRA. Now, if you want to have it in an IRA, that's up to you, but make sure you don't have physical possession of it. That's the best way to keep it as a very clean, good transaction there. This individual who went to tax court took physical possession of the gold through an LLC that he ordered and tried to use this information from this self-directed IRA website saying, you can do this. Tax court said, no, you can't. What happened is that when that individual took physical possession of that gold, it was considered a taxable distribution up to the cost of the coins. Lesson: if you're going to have gold or silver in your IRA, do not take possession of it. Keep it with a custodian or whoever does it, because there's companies out there that do it and will put gold and silver in your IRA, silver ringo coins or whatever, however they do it. Let them keep possession of it. Keep it a good, clean transaction, and don't do it. Or if you're going to invest in gold and silver, maybe invest in mutual funds that do gold and silver instead of actually having the bullion. It just really depends what you want to do. Those are the possibilities there, but just the tax implications of just don't take possession of it. Another area, real quick, going to touch on here. This is more of a software suggestion, is that if you've been using Kaspersky security software on your computer, interesting thought here is that the FCC has labeled this as an unacceptable risk to national security. So if you've been using this, get rid of it and get another type of security software that you can use. One that, like I use, is called Bitdefender. So it just really depends on, once again, what you want to use, but certainly recommend that you make a change there so that you can keep your personal information as your personal information and keep your tax information safe as well. So yes, much that we have considered today through this as we look forward to 2022. So just some areas to be thinking about and looking at, as now's the time as any to start preparing for your 2022 tax return, because January is going to be here before we know it. And if you haven't done proper planning, if you haven't stopped to talk to your tax professional before the end of the year, let's get some of this done. Let's get some of this figured so that you can avoid any unnecessary tax surprises come 2023 when you're preparing the 2022 tax return, which is what the services here we do provide, with year-round planning, year-round approach, help you to set goals, virtual tax preparation, which is really great. Don't even have to come to the office, upload to the secure portal, electronic signature. All of that you can reach here with Marcelino Dodge here at Cash Tracks Financial. We have an excellent blog that you can also view and take a look at our website, cashtracksfinancial.com. Give me a call. It's 844-394-4287. Or the email, of course, is success@cashtracksfinancial.com. And as you visit the website, once again, you can sign up for our free monthly newsletter and our free weekly tax tip so that you can keep up with the most accurate information on taxes. And then, of course, be able to save. So we're truly grateful for you listening today to the Tax Answers Advisor with Marcelino Dodge on the Voice America Business Channel.